Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have Professor Michael Pettis and Ira Harris. Michael is Professor of Finance at Peking University, based in Beijing, China. Ira's hedge fund manager, global trader in foreign currencies, bonds, commodities, and equities for over 40 years. He served as CME director from 1997 to 2003 and also a stint most recently. Welcome, gentlemen.
Thank you very much.
Thank you, Richard. Pleasure. This is a great pleasure.
Great. I thought we'd begin with a discussion, Michael, on your overall view of the China economy relative to the rest of the world. Has there been, or is there being, a focus change from an export-led economy to a domestic consumption-based economy in China?
Well, Richard, a lot of people think of China as an export-led economy, like the Asian tigers and perhaps a little bit like Japan. But I'm not sure that's the best description of the growth model for Japan either. In both cases, what really drove growth was primarily investment, very high levels of investment. And to give you a sense of it, Chinese investment right now is about 45% of GDP. And for many years, it was about 50% of GDP. And if you look back at other countries that had very high levels of investment, the highest ever was South Korea, for which investment for a couple of years went up as high as 40% of GDP. So China is really an investment story. But the way that investment model evolves, and as in the case of Japan in the 1970s and 1980s, there was a very high current account surplus, a very high trade surplus. That's not what drove growth. That was sort of a residual of a model in which, in order to facilitate investment, you had to drive savings up to extremely high levels. So China's in the weird position where it has the highest investment rate in history. And typically, as you know from your basic macroeconomics, if you have a high investment rate, you tend to run a current account deficit, because the current account deficit is the gap between savings and investment. But in the case of China, even though it had the highest investment rate in history, its savings rate was so much higher, also the highest ever recorded in history, that it ended up running large current account surpluses. So the real transition China has to do is from an investment-driven economy towards a consumption-driven economy. And what happens on the export side, on the trade surplus side, is basically a residual and a sort of a consequence of the way it manages that transition.
And your thoughts, Ira?
Yeah, I find it, this, of course, I'm glad this is where we're stepping off, because, I think last year, and Michael, I write a blog, Notes from Underground, and I started talking about this in May of 2020, because so many people who analyze would have thought that the Chinese, that the yuan would have weakened as China would seek to protect its export sector. But lo and behold, from May on, the Chinese yuan performed extremely well. And as a trader, it really caught my focus, because I said something else is going on here. And I don't, I'm not a micro corporate analyst. It's why I admire your work so much. I'm a global macro person. I start top down. And what that told me is, you know what, China's sitting on a lot of dollars. The United States policy, between the swap lines that they had opened up, of course, not with China, interestingly, but they really increased them. And with everything else that they did to head off the impact of COVID, dollars, you could see the U.S. wanted to weaken the currency, and it should have for many reasons. But the Chinese, and that told me that all of a sudden, if they're letting the currency go higher, my supposition was that they would be importing a lot of raw materials, because raw materials had dropped, all types of raw materials dropped so dramatically in price. Interestingly, not the grain market as much as others, but we certainly saw oil and steel, copper, and then all of a sudden they turned, and as they turned higher, the yuan kept going higher. So it really made me think that the Chinese were busy stockpiling all they could, because what better use than to use a weaker currency, or a currency that was the policy was set to weaken, in order to build your stockpiles of things that you're actually going to need. And it drove all types of commodity prices higher for the remainder of the year, where we're sitting now and waiting to see where it goes. But yet, as we look here, the yuan is still sitting at 6.36, which is really 3-year, 30, 40, I think we're at 40-month highs on the Chinese currency, which tells me that that model, the export model that I think a lot of Western analysts have relied upon, is beginning to change. And I just saw some recent data, and I know you cited, but what's his name, Rahul Sharma from Morgan Stanley noted that exports declined from 35% of China's GDP down to 20% of late, and that's a huge shift. But that would denote to me that they were on what you, I know, have been suggesting for 15, maybe longer, about the need to transform itself into a more domestic consumption economy.
What are your thoughts, Michael?
Yeah, I think if I can pick up on that, Richard, I think Ira's point is important. And beginning around October 2019, I was advising my clients that they should be aggressively buying Chinese securities generally, but particularly Chinese government bonds, because they had as you know, a much higher yield than U.S. or Japanese or European bonds. And the risk for many people was the risk of depreciation. But I had argued that there's almost no chance that we were going to see significant depreciation in the renminbi. On the contrary, I expected it to strengthen. I didn't expect it to strengthen as much as it did, but I expected it to strengthen. And I think there's more upward pressure on the renminbi for the next 6 months, or perhaps longer, than there is downward pressure. And there are a couple of reasons for that. The first thing is that the PBOC does not want to see a weaker renminbi. And the reason is that, as you know, the way the currency works, we often think that it works by making exports or imports more expensive or cheaper, but that's not really the way the currency works macroeconomically. When you appreciate the currency, you are basically transferring income from those who are net importers to those who are net exporters. And that basically means the household sector, because households are all net importers, to the manufacturing sector or the tradable goods sector, which are net exporters. And so that's when you depreciate the currency. When you appreciate the currency, it goes in the opposite direction. And the PBOC has been very clear that as part of their attempt to rebalance the distribution of income towards the household sector, which, by the way, they failed miserably at, and they've been talking about this for 14 years, but as part of that attempt, they want to see a stronger renminbi. They definitely do not want to see any weakness in the renminbi, because that reverses the little bit of rebalancing that they've actually done. And so, given their very strong desire to see a stable or stronger renminbi, the question then becomes, do they have the firepower to ensure it? And of course, the firepower is the size of their dollar reserves. And I don't need to tell you that, just the formal reserves, the reserves that we can see in the central bank, is the biggest cache of FX reserves in the world. and in addition, they've got about 3.2 trillion at the central bank. In addition, they have about 1 trillion parked away with the state banks and another 1.1 trillion in the sovereign wealth fund. So they definitely have the ability to prevent the renminbi from going down. And as long as I have that ability, I think it's very unlikely. In fact, if you listen to the PBOC, they keep warning everybody, don't assume it's a one-way bet. It could go down. It could go down. It could go down. And when the central bank keeps warning you, stop going long because it might go down, that's usually a sign that they would like it to weaken a bit, but they're unable to do so. And the reason they're unable to do so is, they're running the biggest monthly trade surpluses that they have in history. Plus, we're seeing more and more financial investment entering into the stock and bond markets. So you've got tens of billions of dollars. You've got more than $100 billion of inflows on a monthly basis. And, what can you do with all those inflows? You can either intervene and see massive expansion in the domestic money supply, which they don't want to see, or you don't intervene and then the currency goes up. So they're trying to do a little bit of each. But the point is that most of the pressure is on the upward side. I think it's pretty unlikely we'll see a weak renminbi, certainly for the next 6 months, but probably even longer than that.
And Michael, do you see the potential for China's currency to be linked in some way to a commodity like silver or gold in the future?
I think that's very unlikely. When you link your currency, whether it's to another currency or to a commodity, you basically give up control of the currency. And in fact, the main reason people who support gold-backed currencies is because it forces a discipline on you because you lose control of your ability to manage the currency. And I think, the idea of losing control is something that has absolutely no takers here in Beijing. It's very important for them to be able to control the currency and to be able to control the domestic monetary system, if for no other reason that debt levels are so high, the highest we've ever seen for a developing country. And they've been growing at the fastest rate we've ever seen. So imposing that kind of discipline, I think would almost certainly cause a domestic financial crisis. So I don't really think that's in the cards. Every once in a while you hear people say that, but it's always foreigners. You never hear people around the central bank suggesting that. And I think there's almost no interest in that.
Interesting. And your thoughts, Ira?
Well, I'm one of those. I raised that issue, and it was interesting to me when the Singapore authorities built that 15,000-ton silver storage facility recently at the Singapore airport. I kind of raised my thoughts, and I only raised it, and I only raised it because if China were to go to a central bank digital currency, I think in order to get the international standing and credibility that it would need, I have theorized for years that they would need to back it. And what better way to kind of stick it in the eyes of the Western central banks by putting some of it on a silver guy. I mean, it would of course almost be like William Jennings Bryan, but to stick them a little for the opium wars and the debasement of Chinese currency, of course, in the mid 1800s. So I always raise that because they're going to have to find, if they go to a central bank digital currency, which I think the Chinese are far ahead of everybody else, that in order to gain its credibility, almost like a stable coin, in the words of Leo Brainerd. But more importantly, and I love that we're having this conversation, I look at two critical times: January 1st, 1994, when the Chinese devalued the renminbi from 5.8 to 8.7. And then what I pay attention to is June of 1998, when Bill Clinton made his famous trip to China and didn't go to Japan, but the United States, I really believe, and I think other people, and I think you may have actually written about this at the time, that the U.S. Treasury intervened to strengthen the yen, and that was at the behest of the Chinese because the yen had gotten way too weak on a trade basis and was really impacting some of Asia. So I look at those levels, and I watch especially the renminbi, the yuan because that's what I trade versus the yen, and we're actually above those levels of 1998. Was like 17.4. I thought when they thought the yen was too weak. So the yen is actually weaker now, up at around 17.8 or so. So I'm watching these levels because to me it's a better statement about where China is prepared to go here, if in fact they're allowing, for lack of a better word, a stronger currency, will of course, and I pick up on your thesis because I think your thesis has existed out there for quite a while, that a stronger currency enriches and empowers a growing Chinese middle class, but therefore will it lead to China stockpiling ever more commodities, things that they actually use? Not everybody can protect their currency investments by buying artwork or Ferraris or whatever, and you can actually stockpile the things that that you're going to use, copper especially, and iron ore, and we can go on, and food is always an issue and will always be an issue for China. They have more choices now, of course, because Brazil is such a huge grower of agricultural goods, and the real has been so weak, especially against the yuan. So Brazilian products are really cheap for Chinese importers and soybean crushers and manufacturers. So it does bode well. But do you see that from a macro perspective leading to a much higher floor for global commodity prices because of what China is doing with the currency?
Well, it's interesting because obviously the commodity story, certainly industrial commodities, is really a China story, right? China consumes between 50 and 60% of all of the iron ore produced, and almost all the commodities you can think of, they either consume between 50 and 60%, or they consume between 40 and 50%. Even the U.S. at its peak wasn't consuming that share of global production. So the question is why is China just hoovering up iron ore and copper and all of these other industrial metals, cement too? They're by far the world's largest consumer of cement. And I think the answer is because for a long time, and still today, what really drives Chinese growth is investment. And unfortunately, we always talk about China as a high-tech economy. It's not a high-tech economy. It's a very low-tech economy with a few islands of high-tech. Most Chinese investment is in stuff that uses cement and wheelbarrows. A little bit more than 30% of all of their investment is in infrastructure building, and a little less than 30 is in the property sector. So around 60% just in property and infrastructure. And those, of course, are hugely commodity intensive types of economic activity. So as long as China is heavily reliant on those types of investment, it's going to continue to want to import large amounts. But if China is successful in rebalancing its economy away from investment, so in most economies, investment is about 15 to 20% of GDP. In some rapidly developing countries, it's around 20 to 25, maybe up to 30%. So China has a long ways to go, even to become the same as a rapidly developing economy. But as that happens, its demand for commodities will contract very, very sharply. And so we'll probably see much, much lower prices on the commodity side. But for now, I think we still expect, even for all of the talk about they're coming down hard on the property sector, I think that they're really limited in their ability to clamp down on that type of investment. For years, they've been saying, we're going to reduce investment in the property sector. We're going to reduce investment in infrastructure because that's considered, they don't call it low quality, but they call everything else high quality. They just don't give that a name. They would like to reduce it. But the problem that China's always faced is that there are really few other levers for growth. There's the trade surplus. If they were Singapore, they could get away with an ever expanding trade surplus. But the Chinese trade surplus right now in dollar terms is the biggest it's ever been. In GDP terms, it was bigger in 2007, 2008. But in the amount that the rest of the world has to absorb, the Chinese trade surplus is equal to roughly 1% of the GDP of the rest of the world. So that really can't grow much more. So they really have to, if they want to bring down this investment in infrastructure and in the property sector, there's really only three ways they can do it. One way is by shifting all of that investment into the sort of high-tech, high productivity investment, the new economy investment. They've been talking about this for years, incredibly hard to do, if only just because of the disparity in sizes. The second thing they can do is manage this transition towards a more consumption-driven economy. But that requires a huge shifting away of income from the government sector to the household sector. China has the lowest consumption rate in the world, the highest savings rate in the world, for a very simple reason, and that is that households retain the lowest share of GDP of any country in the world. So what you have to do is you have to increase their share at the expense of some other sector, which is basically the government sector, which makes it politically very, very difficult. And I said there were three ways they could reduce all of this investment. One way is to increase good investment, which is tough to do. And they've been talking about it for years and haven't been able to do it. The other way is to increase consumption, which is also very tough to do. They're a bit more serious about that, but they've also been talking about this for 14 years. And then the third way is to allow GDP growth rates to drop really sharply. I would argue probably below 2 to 3%, which for political reasons they also don't want to do. So they're really stuck with this model where they have to continue pumping investment into property and into infrastructure, or else allow growth rates to drop very, very sharply. And so, this is the debate we've been seeing in Beijing, particularly in the last year, but basically for the last 4 to 5 years. And until it's resolved, I think they're going to continue, as I said, hoovering in iron ore and copper and cobalt and cement and all the other industrial commodities.
Mm-hmm. And
so,
yeah, go ahead.
So let me ask, so all of that you just discussed, then of course it does lead to a question that, we sit as investors, and I'm sure you advise your clients regularly. So now we have to look at the quote unquote overinvestment that has taken place, which I think has done more to placate, not placate is the wrong word, to allow the Western central banks and the Japanese central bank to believe that they've had a control on inflation. But I think Japanese investment and, of course, labor has kept a lid on all types of prices. But the overinvestment, and let's go back and put our bonds hats on, have led to there is going to, as we're seeing now, of course, with Evergrande and others, there will be shaky bond markets because of the overinvestment. So do you think that China will make its way just by restructuring this debt, and those who are outside China especially are going to take sizable haircuts as profit margins fall, and this debt's not going to be able to be easily financed as it was before?
Well, as I don't need to tell you, Ira, if you can't pay your debt, somebody ends up paying, right? And so the question is, who ends up paying? You can default, which means that your creditor ends up paying, but the creditor in China is mostly the banking system. Foreign creditors, I think, are going to get hurt. But domestic creditors, where most of the debt is the Chinese banking system. So you can't really let them go bankrupt. So, what else can you do? You can inflate the debt away. You can use financial repression to make it very cheap and easy to turn over the debt at lower than the nominal GDP growth rate. You can repress workers' wages and force them to pay the debt. You can expropriate the rich and basically use expropriation to pay the debt. But at the end of the day, if you owe $100 and you only have $50, well, somebody out there is going to lose $50. And I think that's really the political question for China. How do you allocate those losses? Historically, the way they allocated the losses is by, the way we did it in the States, the way most countries do it. And that's by screwing the household sector. You bail out the banks, and then basically you either play yield curve games or you raise taxes or whatever to pay for the bailout. And ultimately, it's the household sector who ends up paying. And in China, we saw that in the 2000s. So when they cleaned up the banks prior to the IPOs, we saw negative real interest rates for many, many years. And as you know, if you owe money and you can roll it over at a negative real interest rate, well, then the longer you roll it over, the less you owe. But the problem with negative real interest rates is that the net lenders end up losing. And the net lenders were the household sector through their deposits in the banking system. And that made the imbalance. China was already very imbalanced in the year 2000. By the year 2010, it was at surreal levels of income imbalance. So they can't really do that again. And what I would argue, Ira, is that if you just think about the arithmetic of rebalancing, I can tell you ultimately who has to pay. It has to be local governments, because they control something like 20 to 25% of GDP. In most countries, it's closer to zero. And so ultimately, they're the source of the imbalance. But it's politically really hard to do that. If you imagine in a country like China, or in any country, where you transfer 10 to 15 percentage points of GDP away from the government sector to the household sector, presumably that involves a huge transfer of political power too. And I think that that's the problem China has. They've not yet been willing to make that step. But then again, as you know, because of your experience in the bond markets, just because you don't want something to happen doesn't mean that it's not going to happen. At some point, this adjustment has to take place. And if it doesn't take place in the good way, with a massive transfer of wealth from the government sector to the household sector, then if you look back at history, there are basically two ways you rebalance your economy, neither of them very good. One way is the way the US rebalanced in the early 1930s. It's weird to think it, but the US in the 1920s had many of the problems that China does today. Very high savings, huge trade surpluses, lots of misallocated investment, et cetera. And the way the U.S. resolved it was in the form of the crisis from 1930 to 1933, where basically U.S. GDP contracted by about 30 to 35 percentage points, and household income contracted by roughly half that. So you see, they rebalanced. The household share of GDP grew quite dramatically, but in the context of a huge contraction in GDP. But that's one way you rebalance, in the form of a crisis. It's brutal, but it's quick. And then the other way you rebalance is the way Japan did after 1990. Japan, looks a lot like China. Japan in the 1980s looks a lot like China, except that the imbalances in China are much deeper than they were in Japan. And the way Japan rebalanced is GDP growth fell off a cliff. Before 1990, it was roughly 5%. And after 1990, it was roughly 0.5%. But household income didn't drop nearly as much. household income was below GDP before 1990, the growth in household income. And after 1990, household income grew at roughly 1.5%. So Japan rebalanced, but very slowly over a 20-year period. And it just seems to me that arithmetically, those are the three options. Either you rebalance in a good way, which involves a massive transfer of income from the government sector to the household sector, which is really tough to do politically, or you're forced to rebalance in one of the two bad ways. The American way, which is in the form of a brutal but quick crisis, or the Japanese way, which is in the form of a very long, slow adjustment. Aside from that, I don't really see many alternatives. So, to return to your original question, who's going to pay for all of this stuff? I don't really know, but what we do know from the history is that it tends to be a pretty painful adjustment and a pretty painful process.
Well, yeah, I'm glad we're at this point. So in the United States, we did it. Of course, we went to a 25% unemployment rate, which right. we've learned is totally intolerable because when the Tea Party in the U.S. Was ranting that we were almost mirroring the calls of Andrew Mellon, liquidate. And I used to do a lot of TV with Rick Santelli, and when Rick got into a rant, I said, that's not going to happen. You are not going to go into a liquidation mode, because I think the Tea Party were almost Calvinistic in their views. Well, you took on this too much debt, you should be punished and let prices go where they can. I said, that's not going to happen again. The United States could not tolerate a 25% unemployment rate in 1930. It is absolute 12% shakes everybody. And we saw the immediate response is they would go to, I think Ben Bernanke staked his everything on it that we were not going to repeat the 30s, especially 37, and get to a situation where you were going to have unemployment rise so dramatically in an effort to to cleanse yourself of the debt. It was not going to happen. And of course, Tim Geithner was going to protect Wall Street. So the banks, which he did, and I hold him highly accountable for that and in very low regard, because Main Street did, as you point out, did pay the price. But in looking back at Deng Xiaoping and those who came before Xi, and I'm not asking you to speak about Chinese domestic politics. It's always a difficult situation. But can the households in China bear paying any of the costs that will need to be taken? I love that you discussed the local governments, because it is a very highly unusual that they control so much of the economy. Maybe that will make it easier. In Japan, and I always point that out to people, Japan went into that terrible decade of the 90s, but they had huge household savings, which I think was able to cushion the blow. And of course, they didn't lay off workers in the traditional manner that Western economies would have. But those, and I think the massive savings which they had to eat through helped ease the pain of it. The United States has never had that kind of, well, I won't say ever, but certainly in the last 40 years, we don't have household savings like that to be able to mitigate that process. But will the household sector in China be able to absorb that politically?
That's, you bring up all the key points. When you look at the kind of adjustment that China needs to make, there were some really interesting papers written by, I think it was Darren Acemoglu and James Robinson at the beginning of the last decade, in which they argued when you look at countries that have to make this kind of adjustment, the track record isn't good. It's politically fraught, and many countries have political crises. Now, what they argued is that there seems to be two kinds of exceptions. One exception is very robust democracies, which isn't a surprise. I mean, the advantage democracies have economically over all other systems is that democracies adjust, and adjustment is an ugly, messy process. And when they're adjusting, our love for democracy declines a great deal. It loses its prestige, which is ironic because that's exactly when it's doing its job. But so he argued that the United States in the 1930s is a classic example. The kind of adjustment that the US went through would have broken most countries. But because it was a democracy, somehow we managed to stumble through. And when you read during that period, as I know you have, there was a lot of concerns, not just that we would at some point have a communist or left-wing revolt, but there are many historians that believe in 1937, 1938, we came close to a right-wing coup. So it wasn't easy, but we managed. Acemoglu and Robinson say the other type of system that seems to survive these types of very difficult adjustments are the exact opposite, really highly centralized autocracies. And there the classic case is the one you bring up, which is the reforms that Deng Xiaoping did in the 1980s. We forget that those reforms were ferociously opposed by the Communist Party elite because basically he was taking away everything that they had, all the power that they had accumulated in 30 years. There was huge opposition to it, but China was so heavily centralized and the military was supposedly quite loyal to Deng Xiaoping that he was able to pull it off. So if you believe that story and you were advising Xi Jinping in 2012, your advice might have been the adjustment China must make is tremendous and either become a democracy, which, okay, it ain't going to happen, or centralize power enough that you're able to force through the adjustment. And it almost looks like that was the advice he decided to follow. Now, whether he followed it for that reason or some other reason, I don't know, but there's been this huge centralization of power. And what I would add, Ira, is that, if I want to become more powerful than you, there's two ways I can do it. I can increase my power or I can reduce your power. So it's not necessarily a bad thing from Beijing's point of view if the local governments are forced to pay for the adjustment. It'll significantly reduce their power vis-a-vis Beijing. And as you know, in China, we have this mistaken view that the secretary of the party, basically says jump and everyone says how high. That's not quite true. Local governments in China are extremely powerful. So maybe there is a very interesting political adjustment taking place that is the prerequisite to the economic adjustment. I'm not smart enough to tell you if that's the case or not, but what I can tell you is that the historical precedents are pretty clear. An adjustment of this nature is very tough to pull off and often involves all kinds of political consequences that were not predicted at the time.
Well, Richard, I mean, we're sitting with you, and the name of your platform, of course, is the Financial Repression Authority. Now we see that. Listen, the Fed is pulled off, and I know Carmen Reinhart has written extensively over the years about the financial repression that took place in the late 40s in the United States with the suppression of interest rates in an effort for yield curve control. And we see this in picking up where Michael talked about, which is in a democracy, that you really have gotten away with a massive financial repression of savers by design. Now, you could say, well, you should and ought to have gone into the equity market where asset price inflation took place. But if you've been an insurance company, a pension, a very staid pension fund, and have had your investments in bond markets, this has been an absolute financial repression, and that's from a democratically based government. So actually, could China financially repress its massive savings class and bail out some of the more heavily indebted governments and businesses that will have to be, because I mean the overinvestment in China has been massive, and in the classic Austrian sense, when you get that type of overinvestment, somebody's going to pay. Who that is, well, a lot of times that, or most of the time, that's a political decision, unless you believe in laissez-faire economics and you let the markets. But we know that's not going to happen, especially in today's age when it's so much easier to control from above, and not just by the Chinese Communist Party. We see it done pretty well all over the rest of the world. Look what's going on, especially in Europe, and the power of the ECB to absolutely financially repress. As bad as it is in the United States and other places, I think Germany is really struggling under a massive financial repression, and it's starting to hint that it started to hint at the politics a while ago, but now we've seen change in government, and will it be more frequent? But I wonder about China. I mean, can they financially repress the household savers without a major pushback?
Yeah, and also just more generally to add to that question, how does China manage interest rates today? Is there yield control, or do they make use of the Hong Kong financial markets in managing interest rates?
Those are all really really big questions. Now, to address the first, or I don't know if it's the first, but I think one of the most important ones is, can you use financial repression to solve the problem again? One of the great things I always tell my friends about being here in China is that you see the same sort of problems all over the world. It's really amazing. We're all seem to be making the same sets of mistakes, but they're sharper here in China. They're more extreme here in China. So in a sense, there's more clarity when you look at it. One of the big problems that we have in China, in fact, the key problem, is really this problem of imbalance. If the consumption share of GDP is very low, there's only three sources of demand for any economy: consumption, investment, and then foreign consumption and investment, which is the trade surplus. So if consumption is a very low share of GDP, then by definition, growth depends on investment. Now, this isn't necessarily a bad thing. In the 1980s, China had gone through 5 decades of anti-Japanese war, civil war, and Maoism. And as a consequence, it was one of the most severely underinvested countries in the world. It was from a social point of view, in terms of health, education, et cetera, it was a middle income developing country. But from an economic point of view, it was one of the poorest countries in the world. It had no subways, no bridges, it had 4 commercial airports in a country the size of the United States, and blah, blah, blah. So under those conditions, the best thing you can do is to have extremely high investment. And because you don't want to depend on foreigners to fund your investment, you want to fund it domestically, then the best thing to do is to force up the savings rate as high as you can. And the way you force up the savings rate is that you reduce the share that Chinese workers receive of what they produce. So you pay them less, and as a result, they consume less. And so the savings rate is higher. You invest all of that savings in building the economy, and everyone benefits. It's the way trickle-down theory should work in practice. You get very rapid growth, and although workers are getting underpaid relative to what they produce, the amount that they produce is growing so rapidly that their pay also grows very rapidly. The problem with this model is that it works as long as you are hugely underinvested relative to what you need. Once you close that gap, then your investment needs are determined by demand. If people are buying lots of stuff, then your businesses will go out and invest to expand production. But the problem in China is that people weren't buying very much because their share of income was so low. So you had to make that switch, and because they couldn't, they just kept on pressing on the investment accelerator. And when you invest productively, your debt grows, but your GDP grows just as quickly or even faster. So debt doesn't seem like a problem. But once you start investing non-productively, then by definition, debt grows faster than the economic benefits of that debt, and your debt to GDP ratio starts to rise. So this happened around 2007, 2008, and it really rose very, very quickly. So the problem in China then is that if you want to solve this problem, if you want to reduce the growth in debt, you must reduce the growth in non-productive investment. And if you want to reduce the growth in non-productive investment without seeing growth collapse, like in Japan, then you need consumption to surge, because that provides demand directly, and it provides it indirectly because then businesses start investing in order to serve that consumption. That's really the key thing. And that's the problem with solving the debt problem through financial repression. Because financial repression, the way it works is you have excessively low interest rates, which is a transfer of wealth from net lenders to net borrowers. And net borrowers in China, there's a lot of households who have borrowed, but net borrowers are mostly the manufacturing sector and local governments. And net lenders are mostly the household sector because they have a high savings rate, which is deposited in the bank. So financial repression basically means you solve the problem of debt by taking money from households and giving it to the borrowers. The problem with that is that we have a debt problem precisely because so much money was taken away from the households that they weren't able to consume. So in a funny way, you could solve the debt problem through financial repression or through inflation, which is basically the same mechanism. But if you do that, you make the imbalance worse. And if you make the imbalance worse, then in the future, you're even more dependent on bad investment to generate growth. Mm-hmm. So they're sort of stuck. As you mentioned, Ira, the easy way out is always to screw the households. In this case, they did it 10 years ago, or 15 years ago. They can't really do it again. I'm sure they would like to, but they can't. So there's got to be some other solution to this debt problem.
Your thoughts, Ira?
Yeah, I love this because this is, I think, getting to the heart of it. Is not just China. Is
it's the whole world.
Oh yeah, and we've sat back and allowed them, as we in the United States. We've been talked to, meaning people of my age, who are quote unquote in the retirement cycle of their lives, but we've been told stop. As Bernanke and Yellen when they were both chairs of the Fed, and they would come under harsh pressure because zero interest rates as part of the policy were crushing savers, and they would get letters and they would read them, and the response, both of them were, stop complaining, stop crying, your grandchildren, this, and I'm not, I'm paraphrasing, but not really. Stop crying because your grandchildren have jobs, your neighbors have jobs, your house has gone up in price, and your stock portfolio and your investments have gone up. So yes, yes, you're being financially repressed, but you're coming out on the other end. Stop your crying, which is every bit as much a policy as the CCP in the way that they would talk to people. And it's interesting to say they may have overextended that. Well, I think we're seeing it, especially now, because as the new measure, but it's not really a new mechanism, because if you look into the U.S. academics, Rogoff, and in fact, in July, Rogoff was still writing columns. But if you go back to this time, it's different. When part of his formula for resolving the great financial crisis was, of course, to endure 3, 4, 5 years of 4 to 6% inflation, and in order to ease the burden of carrying that debt. Of course, we go back to Fisher's monetary illusion, and that's where it resides. So, and he wrote a piece, meaning Rogoff, in July in the FT, citing it again, that some inflation is not a bad thing. And I think Krugman was out. I didn't read his column because I have a thing about certain things, but I know that it got some play because Krugman, what are you worried about inflation? Well, that is, the tried and true, going back to, if I go back to Burdell's work on the Mediterranean economies, which I was lucky to learn under great professor Ed Friedman and all, it's the tried and true way of easing your way out of massive debt situations, as a core of inflation, as long as you can sustain it politically. So what is everybody complaining about? What is everybody so concerned about? So it's interesting to see where China is going, but China is no different than the rest of the economy. I mean, really, the ECB and the financial repression of Germany is probably the worst going on right now. Yes, there's emerging market countries who are running high inflations, but they're actually trying to get ahead of it. Look at what the Russians under Elvira, I can't pronounce her last name, but they're trying to get ahead of it because they know that they're borrowed up in dollars. And I guess this brings us to the next, is that all those entities that are borrowed up in dollars, if the dollar rallies too strong here, and I'd like to hear Professor Pettis talk about that. If the dollar really rallies here, the huge amount, and this is from the Institute of International Finance, that we're almost up to 300 trillion in global debt. Of course, it's not all dollars, but let's say that 55% of it, just based on the dollar's status, that if the dollar were to really rally here, that the global financial system gets very, very shaky. Maybe they're going to have to let the inflation run and let and just ease their way out of this enormous debt burden.
Yeah, the irony is that if a rising dollar creates problems in the developing world, then rich people in the developing world will be more likely to take their money out and buy dollars, which of course pushes up the price of the dollar even further. Every time there's a problem in the world, everyone rushes out and buy dollars. So we get locked into that self-reinforcing process. It's a really interesting set of problems. Here in China, I think one of the big concerns, all of this talk about making the yuan a global reserve currency, which they've been talking about. I've been in China for 19 years, and it's always been in 5 years, it'll be a major currency. In 5 years, it'll be a major currency. It won't, because to become a major currency requires huge changes. Why do people buy dollars? They buy dollars because of very high quality governance, deeply liquid markets, very flexible financial markets. If a foreigner buys an American, if a foreigner buys an American asset, he or she has exactly the same rights as if an American bought that asset. So if you really want your currency to be a global reserve currency, it's pretty easy. You have to remove all capital constraints, and you have to credibly guarantee the rights of foreign capital relative to the rights of domestic capital. In other words, you cannot discriminate between foreign and domestic capital. And in China, they keep talking about the advantages of having a major reserve currency, but the central bank and the people in the CBIRC and the Ministry of Finance, I think they understand that the cost of having a dominant reserve currency means completely giving up control of your financial system and of whether money comes in or out of the country. You simply cannot stop it. And they're not willing to do that, which is why I think the dollar will continue to remain by far the dominant global currency until the U.S. itself decides that enough is enough, and we need to shift the monetary system away from the dollar. The problem there is that I think the dominance of the dollar is great for the American banking system. It's great for the foreign affairs and defense establishment because it gives the U.S. a huge geopolitical tool. But it's really bad for American workers, for the American middle class, for small American producers. And at the end of the day, I think the former have more power than the latter. So it'll be a while before we become rational about the dollar. But as long as this continues, what happens to the dollar is hugely important to what happens to all of these other countries, particularly developing countries that borrow heavily in dollars. And I'm not really sure how that plays out, but it is something to worry about.
I love that because I know you have written so long in response to Jacques Rueff and Giscard d'Estaing when they referred, of course, in typical French fashion, that the dollar was an exorbitant privilege, and you have responded, I know, many times that it's an exorbitant burden. So really, I'm glad we got to that because I've always read that, and having read Rueff and Monetary State of the West, and it is. So when you bifurcate it between the U.S. military establishment and what would be the more imperialistic elements in U.S. Policymakers, the dollar is having that role. But it does, its burden is vast. And it was interesting as we embarked upon when the Fed responded to what was taking place back in March and April of 2020, that they really picked up that they had three mandates, because they not only have a mandate of employment and inflation, they have a mandate of keeping the global system liquid. So exactly. That was, the massive opening of the swap lines, and more importantly, I don't know why Powell hasn't been really whacked more by others, but when he walked in the path of what the G30 proposed back in the summer of this year, when for the standing repo facility, and it's really an unlimited number. They put a number on it, but when you look at the intricacies of it, the standing repo facility is basically what the discount window used to be, but now it is for the entire globe at any one time, to prevent a massive sell-off in U.S. bonds, because instead of having to raise cash, they can do the swaps with you or in the repos. So it's, the United States is the lender of last resort, but it's not a domestic event. It's a global event. And I think very few people understand that. And it really calls into question, about what role does the dollar take, and can they let it appreciate? Are we at that point where there's so much borrowing and so much debt overhang in dollars from people who don't necessarily earn in dollars, but because of the Fed policy being zero for so long, have made it a funding currency in the way that the yen used to be? And then everybody thinks that the yen's a haven, but it's really just representative of when things start to turn and people get nervous about their investments. They're short yen and they have to buy it back. So how far can they really let the dollar rally? And I think the Chinese are actually ahead of understanding this. And because they own so many dollars, I think they have to be very careful, because how far can the really dollar go? Yes, the rule of law is probably the greatest, or the respect for law is probably the greatest credible factor that the U.S. has in its arsenal. But if you continually repress dollar holders in their savings, you could really befoul that.
Well, I think that would be, frankly, a good thing if foreigners stopped buying dollars, because the way it works, China keeps saying it wants to stop buying dollars, but what can they do? If you have a problem of deficient domestic demand, if you save more than you invest, and it's really hard for you to change that, then you must export those excess savings. And that's the same thing as running a current account surplus. So who do you export the excess savings to? You try to export them to Japan, and they get very angry. When the Chinese started buying a lot of yen, I think it was in 2009, the Japanese warned them and said, if you buy yen, you have to let us buy Chinese government bonds. And the Chinese said no. And so, that stopped. You can buy euros, but people are nervous about the euro. You can, in principle, lend it to developing countries, which is really what you should do. But 90% of all of excess savings go to rich countries, not to poor countries, because lending to developing countries is extremely risky. So you don't really have a choice. The Chinese have to buy directly or indirectly, they have to buy dollars. And the problem is that as long as all of this money is pouring into the US doesn't need it. You'll still hear old-fashioned economists say that the US needs foreign money in order to bridge the gap between investment and savings. But they have it backwards. American companies are so flush with cash that they don't really need more cash from abroad. So when Chinese money comes into the United States, it doesn't cause American investment to go up. American companies are sitting on huge piles of cash and they don't know what to do with it except buy back their own stocks or buy other companies. So it doesn't cause investment to go up, but by the rules of the balance of payments accounting identity, it must cause savings to go down. So the US has a very low savings rate because it can't control its savings rate. As long as foreign money comes into the US savings rate must remain low, and it remains low either through rising unemployment or much more likely rising debt. And I think it's not a coincidence that ever since the system opened up in the late 70s and early 80s, the US has been cursed with inexorably rising debt, whether it's household debt, corporate debt, or government debt. It's always one or the other, but debt levels are always rising. And I think until we change that system, it will continue until it breaks down. And if it breaks down, I think that'll be devastating for the world. But what really intrigues me, Ira, is that this whole idea of open capital markets and it's good to let money come into the US. This is a pretty modern idea. Even in the Bretton Woods, when Harry Dexter White and John Maynard Keynes disagreed on so many things, they both agreed that open capital markets didn't make sense because there was too much non-fundamental capital, speculative capital, debt capital, currency speculation, etc., that would overwhelm the real economic needs of the countries that were receiving or losing capital. And so they felt that capital controls made a lot of sense. And the US had capital controls basically until 1983. But in the 1980s, we suddenly convinced ourselves that the sort of unlimited flow of dollars into and out of the US is good for the US. And ever since then, we've been running massive current account deficits, not just us, but all the countries that are like us, basically England, Australia, and Canada. We all have the same problem. And it's amazing to me that we haven't really reconsidered our approach to this. Do we really need this? Does it really benefit Americans to have the dollar as the dominant reserve currency? Well, it depends which Americans. It benefits Wall Street clearly, and it benefits the foreign affairs establishment clearly because it gives the US an enormous amount of geopolitical power. But it's bad for American farmers, bad for small producers, bad for American workers, bad for the American middle class. So, I think we really do need a shift in the way we think about this. But I honestly, I'm not terribly optimistic. I think it's going to take a while before we start really rethinking the role of the dollar and whether or not it benefits us. We're moving away from China. I apologize.
Great. Yeah. Just a final question. Michael, do you see China taking on a global leadership role in environmental infrastructure and investment, given its many challenges in its environment, from massive growth resulting in lots of pollution challenges, and also with the global initiatives on the environment? Do you see that potential for that?
I hope so. And there's a lot of talk within China about environmental issues. And China is one of the countries that will be most hurt by deterioration in the global environment. And a lot of young Chinese realize that. But the cynic in me says that when things are going very well, you are willing to shoulder your responsibilities. But when things aren't going very well, you sort of forget those responsibilities. And what I'm afraid is that if we see a significant reduction in growth in China, which I'm expecting, it will be harder for them, to commit to those environmental goals, not just for them, but for everybody. So I hope I'm wrong, but I am a little bit worried about how serious not just China but the whole world will be about environmental issues.
And your thoughts, Ira? Final thoughts?
Yeah, I really don't have much to add to it. I think if China sees it as an advantage, that they will move that way because that'll move them up the tech ladder, almost like Japan moved up the a higher level manufacturing. I mean, they're far from that, but I think it becomes, I think, and you see the pushback of China because when they talk about carbon taxes on imports, everybody's pretty sure they know who that's directed against, and the Chinese, I think, become very very leery of that language. But will that push them that way? Yeah, I look at the discussion about the green investment. If it's good and the young people get behind it, it's almost like what's his name back in the 1600s, the great mathematician, French man who became religious, and they said, well, it's kind of illogical. He says, well, if it improves my life, what have I lost? And I think that it's a big part of it. And as long as it's not, as it becomes much more economical, it certainly makes sense to begin moving that way. I have really beyond it, but I think when China sees it in its interest, it'll do what is in China's interest. We see that in many spheres. When China believes it's in it, just like everybody else, they're no different than anybody else. Look at the U.S. with the role of the dollar, and sanctioning everybody and having that power to sanction. They do what's in their interest. End of story. Why should they be any different? And they will protect their interests.
Well, great. It's been a very insightful discussion. How can our listeners learn more about your work, Michael?
I'm on Twitter, and I tweet pretty regularly about the Chinese economy. It's at Michael X Pettis, and then I have a blog at the Carnegie Endowment, which I do my bigger things, and then I publish lots of bits and pieces here and there.
Great. And Ira?
I'm not doing as much writing with notes from underground, although, every once in a while I will push one out and discuss because I love the discussions. And Richard, I love coming on the Financial Repression Authority because I get to speak with people like, Michael Pettis. This is such a great treat for me. And we get to discuss some really in-depth issues that I think are very important for people who are traders as well as investors, especially from a global macro perspective, because it's important. It's important to look at it in any way and decision you're going to make as to what you're going to do with your money in this world that's so fraught with landmines across the entire investment world. And I think when you really dig into these, from looking at it from a top-down perspective, you will find your way as best how to navigate the world. So I love doing these. This has been a great honor. I would advise anybody to, when you see things by Michael Pettis, you should stop and read them and at least get you to start thinking outside your comfort zone. So this has been great.
Thanks very much, Ira. And I wish I could tell you next time you're in Beijing, please come by and talk to my class. But I don't know when we'll ever be allowed to travel again.
Yeah. Oh, yeah. It's very interesting. I do get to, I have that copy of what I showed you because my son is actually a Japan expert, and he in that same Far Eastern Economic Review, he has a book review in there. So, I mean, he's the one who really, when he was in as an undergraduate, we would talk about things, and he kept saying, "Hey, have you read Michael Pettis? You read?" I said, "Well, let me get to it," and I did. So he was the one who really pushed me. So I would love that, and I will find you if that's the case. My wife and I need a vacation, but when will it take place? None of us know. We don't have that crystal ball.
Great. Thank you so much, gentlemen, for the discussion. Thank you.
Oh, thank you. This was great. And I'll put it out to they've actually been waiting for this because I talk about you, Michael Pettis, in my blog. So, whenever I see something that you write, I'll cite it and hopefully they'll get to it. And China plays a big, and we really like to get to the, not the hysteria of China reporting, but to really look at it. So this has been great. I appreciate it.
Thanks very much, Ira. Thank you, Richard. I hope we can do this again.
Yeah, this was great. Yeah, I would look forward to it. Thank you, Richard.
Yeah. Thanks, guys. Yeah.
Okay.
Take care. Yeah. Bye-bye.
Bye-bye.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.